Well, just 5 years ago, almost no one outside the natural gas industry had heard of something called fracking, even though the basic technologies were not new. Well, now a new process called enhanced oil recovery could completely change the oil and gas markets in the U.S. But are the advances in the oil and natural gas industry going to come to a screeching halt thanks to crashing oil prices? I spoke earlier with Marin Katusa, author of the New York Times bestseller, The Colder War, How the Global Energy Trade Slipped from America's Grasp. And I began by asking him what oil-enhanced recovery actually is.
Well, you see, fracking's been around since the 40s. They've done it in Russia, they've had it in the U.S. since the 40s, in Europe, countries like Germany. And really the technology breakthrough was George Mitchell, which Mitchell Energy eventually got out by bought out by Devon. And they took the vertical drilling, they brought in the technology to go horizontal, and now they can frack horizontally. You know, 5, 6 years ago to do a 8-stage multi-frack was science fiction. Now it's just, you know, elementary. So now they're doing 64-stage fracks, and they're bringing in super pads and super fracks. So the technology has been incredibly advanced over the last 4 or 5 years.
It's fascinating to watch that change, and yet right now the fracking boom in the U.S. is starting to slow down thanks to the Saudis flooding the international market with oil. 3 states, Texas, Alaska, and Louisiana, already expecting layoffs and huge budget deficits because of the drop in oil prices. Is the fracking and shale industry going to be delayed or even damaged by these low oil prices?
Well, you see, since 2008, the U.S. domestic shale sector has increased their debt on the corporate levels by $150 billion. So there's a lot, because there's so much cheap money. You know, a big effect of QE was coming into the shale sector because people were chasing yield. So a lot of this cheap money came in, the technology, the exploration came in. So the question is, how's this debt going to be rolled over? So there's going to be a lot of questions here. A lot of the shale doesn't work at $45, $50 oil. So you will see eventually by the end of 2015 some of the production decreases. So if you take someone like Texas, if it was its own country, it'd be the 8th largest producer in the world today. And they've gone from a million and change just 5 years ago to over 3.2 million barrels a day. You will start seeing the declines come in and less wells to replace that, but it will take some time.
That number that you threw out a minute ago, about $40, $50 a barrel, starts to really have an impact on shale. Oil prices have been falling. They fell some 47% from $106 a barrel in June down to $55.73 a barrel in December. We're hopefully we'll get Marin back there. The Saudis say they could go as low as $20 a barrel. Do you think that prices will drop that low? And at what point does the U.S. say to the Saudis, you guys are killing us here, figuratively and literally?
Well, I'm a contrarian. When we run our hedge funds, I would love to see oil go down to 20 because the replacement cost would be very difficult to bring on any production, any new production at those prices, even in Saudi Arabia. When I went to Kuwait, you know, still they can claim their marginal costs are $10. I went to Kuwait, and the reality is it still costs the same to drill these wells. Yes, they got shorter paybacks, but $20 is pretty low. I'd be surprised if it went down there. I could easily see oil get down to the 40s, but $20, I'd be pretty surprised.
When we talk about this issue, there are a lot of reports right now that are kind of hitting the newspapers across the country. What's a newspaper, right? Hitting media reports. And one of the things you keep seeing over and over is the kind of the wringing of hands saying this is going to hurt us and jobs will be lost because of this. But at the same time, Marin, we're talking about hundreds of dollars a month going back into the pockets of everyday Americans who aren't paying those high prices at the gas pump. Hopefully energy costs fall, you know, coupled with that, as well as the costs of air travel. Isn't this a good thing overall to see these prices where they are right now?
Not really, you know, and I wrote about this many months ago when I said the oil's going to drop. Where have all the high-paying jobs been? They're not at Walmart. They're not at McDonald's. They're in the oil industry. If you take all the real high-paying jobs in North Dakota, in Texas, they're in the oil patch. And the reality is, you take the airlines. They hedge their oil costs so they can actually budget themselves. So it'll take some time for these low oil prices to work its way through the system. So yes, at the end of the day, the last person to benefit from it is the retail person in the prices, but the companies hedge themselves. And when's the last time you see all these oil taxes on these airlines? They don't ever take those away. Just like governments, they don't take taxes away. They put more taxes on. So will it help the average American? No, it's actually going to hurt them. And on our website, we talk about all the specific reasons why. But no, it's a bad thing for America, especially the $150 billion of debt on the U.S. shale sector, that at $45, you can't finance that debt.
And what happens to that debt at that point?
That's a, you think about just the debt on the U.S. shale sector works out to be about 40% of Russia's total debt. So, everyone can talk about Russia's debt. The real question is what's going to happen to the debt in the U.S. sector? There's going to be a lot of defaults. What about the trigger effect, the derivative effects? This spillover could be a domino, and it's very, very bad news. This is like the black swan that no one's talking about in the U.S. Sector in the economy right now. So there's a lot of risks here in the U.S. Shale sector.
So in terms of Wall Street, in terms of what we saw in 2008 with major economic problems, you're saying that this could actually trigger a similar type of event or even a worse event?
It'll be even bigger. Like what's going on right now in the U.S. shale sector will be bigger than Lehman Brothers. And no one's talking about it because the last thing Obama wants to talk about is that there's problems in the U.S. sector, but they're real. And, what happens to the bankers and the financiers and the hedge funds that have all invested in this because everyone's chasing yield. So to get that yield, they're going after riskier and riskier assets. And no one expected the $45 or $50 oil to come in when things were looking rosy at $100 oil. So there's a lot of questions to be answered here in the U.S. sector.
Certainly sounds like a lot of questions, and we're glad that we have your insight here. Marin Katusa, Chief Energy Investment Strategist for Casey Research. Thank you.